In this course we'll take a more comprehensive look at money in business. As accounting technicians, we're primarily interested in recording transactions. In Canada, these are denominated in Canadian dollars. One of the underlying assumptions in accounting is the stable dollar assumption. As we'll discuss in the next slide, this concept is, for the most part, false.
We use historical cost in accounting because it would be too difficult to adjust prices to some notion of fair value. But this ignores the impact of inflation. On the financials, long-lived assets such as land are usually undervalued. A piece of land purchased in 2002 for $100,000 would probably be worth a lot more in 2022. However, it would still be shown at the $100,000 cost. Economists attempt to deal with inflation by using constant dollars. They use the Consumer Price Index to adjust for inflation. They take the annual Consumer Price Index to arrive at a constant dollar amount expressed in terms of a base year. Statistics Canada publishes many surveys in constant dollars. For instance, to adjust July 2022 price levels back to their equivalent amount in the 2002 base year, we apply a factor of 153.1%. In other words, we divide the 2022 value by 1.531. It also requires that we know when the item first appeared on the financials. Land on the financials is recorded at the cost amount, at the time it was purchased. So, if we wanted to adjust the financials to constant 2002 dollars, the task of adjusting the cost of the land would be very complicated. We would need to know both the cost of each item and the date it appeared on the financial statements. If the land first appeared in August of 2012, the appropriate factor would be 121.8%. However, this adjustment assumes a particular weighting of a representative basket of specific goods and services. It doesn't relate specifically to the market for land. In Canada, we had a very long period of unusual increases relating to real property.
As an analyst, it would be extraordinarily difficult to evaluate financial information that relied upon extensive restatements using imperfect approximations like the notion of constant dollars. It is better to rely on financial statements prepared on a historical cost basis, at least then the analyst would be aware of the particular risks relating to specific items.
So we've seen that financial statements are put together using the historical cost assumption. $100,000 in 2002 is not the same as $100,000 20 years later. In our introductory course, we looked at two fundamental financial statements, which are the only statements required to file taxes. In this course, we'll introduce the statement of cash flows. We'll see how accountants and business analysts can develop a statement of cash flows, almost automatically, just by looking at a comparative balance sheet and income statement.
The first job of an accountant is to measure what happened in an accounting period. They report to management on what happened in the financial statements. But the job of management is to plan and guide operations in such a way as to produce the desired results in the future. Management, like economics, history or sociology, is a social science. Managers are forced to deal with uncertainty in the course of managing an organization. Managing cash flows is fundamental to an organization's success and its survival. The statement of cash flows helps us understand how the operations of the business align with the financial position of the entity from one period to the next.
The statement of cash flows illustrates how investment and financing activities and the operations of the business affected the financial health of the company in the past. When projecting into the future, we invariably look at what already happened. Historical financial results provide a template or checklist when trying to determine what will likely happen in the future. There are different types of money and each has a different cost profile. If a business pursues the wrong type of money, it will be too expensive and can cripple the business. There are also different types of business. High-growth businesses can potentially pursue equity from venture capital or angel investors, but the cost will be high. But most businesses are lifestyle businesses and typically need to find other sources. Traditional debt financing is usually restricted to companies with a track record, and often requires personal guarantees. In this course we'll look at various sources of funding from a statistical point of view, and the likely cost-benefit of pursuing different types.